Hi, this is Jessica Potts, and this is my rebuttal to Kathy Morrison's pros and cons to having an IPO. Um, Increased capital, yes, there we would have an opportunity to make some money, but by selling equity, a company will open itself up to more stringent regulations. And if the company is trying to make quick cash to pay off debt, the shareholders' equity will be less valuable than if the company had the means to pay its own debt in the first place. Increased value to the company and employees. It takes money to make an IPO, and the company should be ready to increase management staff and recruit a board of directors. This may or may not increase the value of the company for employees and its owners. It may lead to the company further into debt initially. A company who is experiencing growing pains to begin with, this may be the reason why they've decided to go public. Uh, they may not know how to handle further growth once the IPO is completed. The company will also have to maintain investor confidence for the remaining life of the organization. They have to be prepared to give full financial disclosure and have a super team of professionals to perform operations, handle marketing, and plan strategically for the future of the company. For creating value, it is possible that a company will not reach its full value in the IPO. Many initial public offerings are underpriced to make up for the risk that the potential shareholders are taking. The shareholders are concerned about levels of liquidity and the unpredictability of the level at which the stock will trade on the market. So the less liquid and less predictable the shares are, the more underpriced it will be in order to make up for that risk for the investors. Therefore, a company may not reach full value in the first go around when going public. For control, a board of directors will be elected by shareholders. Therefore, the original owner of the company might maintain control over day-to-day operations, but many organizational decisions, such as the decision to follow an offering and go back to the market, that would require board approval. So this is a figure from Ernst & Young. This gives us the key global IPO statistics for 2009, 10, and 11. In 2009, the number of deals were 577. In 2010, it went up to 1393, and in 2011, it went back down slightly to 1225 IPOs. The capital raised in 2010 was nearly double of that, or was double of that, and from 2009, and it's gone down to 169 billion. So the average deal, the average size of an IPO would be $138 million. So to rebut the con of that it's expensive, sure, it would be expensive initially, but if it was done right, the payout, getting farther out of debt and making a higher profit, could be enormous. Although right now we are seeing a downward trend in the capital raised by IPO deals, Ernst & Young says to prepare early and move fast in order to get a piece of the pie. By making the deal into a journey instead of an event, the company will be able to keep initial costs in check and raise a good amount of capital. As with any venture, a loss of money or a risk should be expected, but if a company has measured the risk factors correctly and is well prepared to take the risk, again, the benefits could be great. Knowing the volatility of the market and getting in at the right time will help curb the risk factors. And then there's being scrutinized. Of course, you're going to be under public eyes. And it could be considered a con, or it could be considered an opportunity. A publicly traded company should be under scrutiny from the public, with the public eye. This is their chance to be leaders in innovation, technology, and expand the free market. As far as pressure, The pressure will definitely be a downside to the IPO. With the loss of independence that comes with an IPO, many have found that going public transforms the entire organization. Because the company is now in the public eye, it has to be more aware of how it behaves. Will it be a socially responsible organization? Will it continue to treat customers with the same level of service? Will the market make innovation strides and actually grow in a positive direction? The company's value is now based on how the market will value it instead of only what the cash flow looks like. And these are my sources. I got some sources from Investopedia and Chapman Library, as well as Ernst & Young. Thank you.